Kia ora koutou katoa. Welcome to Business is Boring. At the height of the 2008 global financial crisis, John Bolton decided to leave his top corporate job running $60 billion of retail lending at a big bank and start his own financial services company, Squirrel. Beginning with mortgage broking, they have worked with people the banks wouldn't or couldn't, developed their own technology for peer-to-peer lending, and have helped over 50,000 people into homes. Founder John Bolton, JB, joins us now to talk his path in business, his advocacy for home buyers, and the housing market. Now, Tanakwe, thank you for being here.
G'day, Simon.
Hey, so what started your interest in finance and banking and led you into what was like a pretty stellar career in the big old banks?
Yeah, well, I guess, I came out of university just after the 87 share market crash. So the economy was absolutely chaotic. I actually wanted to be an architect, but that was way too hard and there were no jobs. So I did a finance degree, and then back then, you could get your entire student loan out in one go. I worked through university, had an amazing job at a place called Electricity Corporation, and got exposed to some of New Zealand's greatest thinkers at the time, people like Rod Dean. And I worked all the way through, so I didn't have a student loan. I drew my entire student loan down on the last day of university and went straight on my OE. And just travelled for a couple of years. And I think, that's that great New Zealand tradition, right? But I was straight out. I didn't want to be at varsity, got out. Went and worked in the UK. I stumbled into a job. You've got to remember that the unemployment rate back then was around 11%. So it was pretty hard getting work. I was so broke. But managed to score a job and got into finance over there, and IT actually. So I was building financial systems and self-taught, and then came back to New Zealand, just landed a job at a bank. And I guess I benefited because I came back to New Zealand quite young. I was 23 at the time, and most Kiwis were buggering off at that point on their OE. So I sort of fell back into the slipstream just as all these youngsters were leaving. And so well-timed. And I ended up in financial markets and treasury, sort of doing financial risk management. Did some amazing stuff with, financial models and stuff that really impressed the bank. And so I just then ended up in this I got over-promoted. It's quite remarkable because I think one of the things I've learned over time is that, it's great to have bright young things, but, wisdom and scars on the belly are just so important. And I didn't have that. I was pretty immature. I probably still am. But I didn't have the wisdom, and I guess I did get over promoted. I ended up as a general manager of products, running the entire balance sheet for the retail bank. So hence $60 billion of mortgages and deposits. And at the time, I would have been 32.
And that's a pretty significant chunk of New Zealand's economy, right?
Yeah, and I was 32. It's a bit surreal now. But I realised at the time that I didn't have the personality to stay in banking. I was kind of a round peg in a square hole, and I'd pretty much hit my glass ceiling. Like, there's no way they were ever going to let me run the entire bank. And they would have been crazy too.
It would have been fun to see it. Yeah.
Would have been fun, but it would have been crazy. So I kind of realized that I'd probably reached the end of what I could do. And I sat down with the boss and said, hey, have you got anything else that's really exciting for me to get stuck into? I wanted to do a startup bank. And they were like, nah, pretty much you're just going to keep doing the same stuff. So it was like, okay, I'm out of here.
And the timing to leave, like right at the kind of peak of the global financial crisis, did that play into your thinking?
I wish it did. Yeah. I wish it did. No, honestly, I think a healthy dose of naivety is behind most success, right? Because I think if you know how hard it's going to be, if you knew how hard it was going to be, you wouldn't do it.
Yeah.
I mean, I left a very high-paying job I had everything set out for me. It was just easy, right? My wife didn't work at the time. We had 2 young kids. I drew out my entire superannuation from the bank, sunk it into Squirrel, opened an office and got going at the height of the GFC. I'd been in head office, so I'd never talked to a customer before. So it was pretty scary. And to be honest, I ran out of money in about 4 months. Because I invested so much into the business up front, into assets and stuff. And a lot of entrepreneurs make this mistake. They overinvest early. I did exactly the same mistake. I ran out of money. I basically went broke. I ended up maxing out the credit cards. I was literally thinking about going and living in, we were close to living in the office and renting out the house. Living in the office with 2 young kids. We had absolutely no money. So I had to, what I ended up doing is I had to get rid of most of my team. So I downsized to 3 of us. And I actually went back to the banks and I asked for consultancy work. And I ended up consulting back to the banks. So I was working a full day consulting to the banks, doing a range of different things, which gave me money. And then I'd come back and work at Squirrel at night.
What did you set out to do and that hadn't quite found that traction in those first kind of 4 months before the money ran out?
Yeah, well, look, to be honest, I had such big ambitions, and I look back at the business case now and it's embarrassing. And I go, my God, I was a GM of, a bank and I wrote that business case. and there was no way I was going to achieve it. It was just way harder. It was 10 times harder than I thought it would be. No brand, no one who knows who you are. They don't understand your story and stuff. So, where are those leads coming from? The good thing for me was, go back to 2008, the internet was still quite young. And, most of the industry hadn't really discovered AdWords. They hadn't really sort of discovered, digital lead generation. So that was a godsend for me. I dived right into that very quickly. Very early on, we kind of got into the space of providing lots of free information out to consumers, particularly to first home buyers. We knew that they were information hungry. We knew that they needed lots of advice, and that was something that no one was doing. So, we got a blog going in 2008. I started writing for the newspapers. If a journalist called, I'd always take the call. I'd always have an opinion. I'd always provide home buyers through to journalists to give them good content. And from that, we just gradually built out, this massive, I guess, content and engine and built the brand.
And all around that kind of mortgage broking, first home buying. Why focus in on that?
Well, because it was the biggest gap. I didn't launch the business like that. So when I launched Squirrel, the intention was to build a bank-like business. So when we launched it, I had mortgage broking there, but I was also brokering term deposits. I was brokering savings accounts. I was trying to broker everything. What I was trying to do is to provide a full bank service, but brokered so that people could get the best of every product. But I just realized I couldn't do that. It's that insight that you need to get really focused on one thing and not spread yourself too thin. And I realized very early on I was spreading myself too thin, and in doing that, I wasn't going to achieve anything because I couldn't cut through the noise. People didn't know who we were, what we represented. And I've made this mistake plenty of times since then as well. So, I'd run out of money, and it was like, okay, we've got to get this thing focused. We've got to know exactly who our target customer is, and we, just all the stuff that we should know. It's all in the textbooks. And dialed the business back, really narrowed it down and said, we're just going after first home buyers. Most mortgage brokers weren't playing in that space. We had an advantage because we were producing large amounts of content. Most mortgage brokers were chasing property investors at the time, and it just felt like there was a gap. It was 2008, the GFC. Everyone was scared, nervous. Everyone was looking for information, and we were just able to fill a gap. But it was hard work. So that first year, I wrote $30 million of mortgages. Now, it sounds like a lot, but it's not. So that would have been about $250,000 of income for the business. It was tough. I was consulting during the day, going back to the business at night. We weren't at break even. We were losing money. We were losing money for probably the first 2 years. About 2 years in, I managed to step away from the consulting and go into the business full time. We got to break even probably between year 2 and 3, but can still remember we used to write. So this is the funny thing, how fast technology's moved, right? Because 2008 doesn't feel that long ago.
No, you see a car that's 2008. Oh, that's new. And you're like, oh, no, it's not that new.
Yeah. But here's the thing, right? We didn't have iPhones.
Yeah.
Our desktops were these big clunky things. We were still faxing mortgage applications into the bank. Faxing. 2008. I mean,
if you're in America, you're still faxing today.
Yeah. But it was just totally different business. We used to write every mortgage settlement up on a whiteboard, and we would celebrate. We had high fives around the office if we hit 5 million in a month of settlements. Today, we do 200 million in a month. It's like, so the business is growing sort of almost exponentially, but it's taken a long time, right? We're 15 years in now.
You know how you were saying, it's in the textbooks that you should focus in, and you kind of knew that you should. How hard is it, though, when you're not making money and things aren't working, to go, okay, the solution to this is to narrow my focus from 100 things that could work to one thing that's not currently working? Like, that's hard, right?
It's really hard. And you keep repeating the same mistake, right? I think there's a real tendency for entrepreneurs to chase shiny objects, the next big thing, it's really hard to break away from that. We all do it. And I think it's being aware that that's your weakness and just not doing it. For me, similar thing with like drugs, right? I don't do drugs. I've never done drugs. The reason is that my personality would go real bad with drugs, right? And I know that it's a slippery slope, and so I just don't go there. Nothing against it, but I just don't go there because I know my personality. And I think it's the same thing with this sort of entrepreneurial thing. I know what my weaknesses are. I know I have a habit of chasing too many objects, and so I intentionally reflect on that and try and stay focused. It's perpetual. It never stops.
How does the mortgage broking business work? Because a lot of people would have, got in touch with a mortgage broker to try and help them, and maybe things didn't pan out. And so, so many of the ways that people interact with mortgage brokers probably kind of think that it's essentially a free service. And, it only probably works one time out of, 10. I mean, how many times does it work? Like, how does it work for you on the side of actually offering that service, and how do you make money out of it?
Yeah, so the idea with Squirrel was not to be a mortgage broker, but mortgage brokering felt like the lowest capital intensive way of entering financial services. Because, to build bigger businesses is just so expensive and hard. These businesses are really hard to scale. Yeah, I mean, you would notice in the mortgage brokering space, there's no one out there really with our scale because it's difficult. It's really challenging. You've got lots of one-man bands, lots of small businesses, guys that are experienced at it, doing their thing, but to actually build a scaled business is very, very difficult. And the reason is that, touching on what you were saying before, it is essentially a free service. I mean, it's not in that, mortgage brokers are paid by the lender in most cases, but certainly borrowers treat it like a free service. So, for all of the applications that we get in, we only convert about 15% of that, maybe 15 to 20% of that into an approval. And then of the approvals, about 80% of them settle. We don't get paid until a mortgage settles. So there's a lot of work that occurs in this business for free. A lot of work. A lot of our advisors' time is essentially spent giving people free advice on the basis that at some point we'll get a house settling and we'll get paid.
And probably means that if you've got only so many hours in a day as a mortgage broker, you're going to choose to really work and focus on people who fit the bill the best already, right? Which means maybe first-home buyers with not such advantages are probably last on the list.
Yeah, well, tricky. Well, tricky small deals. So I think a lot of people maybe with smaller loans that are tricky will find it more difficult with a broker because there's not the financial incentive for the broker there. They're not going to earn much, and the probability of getting paid is quite low. So you kind of combine those things, and I think so there's certainly it's a bit of a flawed business model. And but it's very difficult to change because, the alternative, I guess, is going through the bank branch and equally having a free service, right? So it's difficult to charge for something when the alternatives are free, and essentially it's the same product. So it's a difficult one. The way that we've solved that problem is really focusing on productivity and efficiency. And, we were talking earlier about the democratization of information and advice. So a lot of our information and advice is free. It's on the website. It's in First Home Buyer's Guide, property investing guides. We give away huge amounts of information and advice for free, which builds a community. And with the faith that the community love the brand and they come through us for the advice. So the way I describe it is, an airline plane can fly essentially without a pilot. It can take off, fly, and land without a pilot. But when are you going to hop on a plane that doesn't have a pilot? You don't need the pilot, but you just want the reassurance that if something goes wrong, the pilot's there and can take over, right? I think mortgage brokering to me is the same thing. It's like we give all this advice for free. They still want you there so that if something goes wrong, you can step in and you can solve the problem for them.
Yeah, and there's such an information asymmetry when it comes to one person dealing with a big bank who also have all their other things. People can feel very locked in and having to take whatever's going, right? But if people know the market and what's happening, logically there's some kind of advantage, although often people just have to take whatever's going anyway.
Yeah, look, there's a little bit of it is around price, but not a lot. Most of the banks are much of a muchness. The pricing across them is pretty homogenous. I think where, mortgage advisors add real value, and not necessarily every time, is when there is a complication, when something goes wrong. It's amazing how many houses in New Zealand have, code of compliance issues or title issues, things that can go wrong, with insurance, whether you're buying unconditionally at an auction or, you're buying a property that's got some sort of issue. Maybe it's a leaky building, monolithically clad. There's just so many aspects to buying property that carry risk and are complicated. And I think it's navigating that process and being there to support that process that's where the real value add is.
And we'll be back in a moment with JB to talk building the brand, innovation in their services, and what's next. Hoki mai anō, welcome back to Business is Boring, where we're with JB, founder at Squirrel. So what does the business look like today?
Yeah, well, I guess the brokering side of the business, we're writing about 2.5 billion of mortgages a year, right across the market. So we're throughout New Zealand now. And, we're writing it first home buyers all the way through to we do quite a bit of construction and development funding, which I'll come to shortly. So that's the brokering side of the business. And but then we've got the peer-to-peer lending side of the business. Peer-to-peer's kind of got this dirty reputation, and it's a bit of a shame. If you think about it from both from a technology perspective and from a transformational business model perspective, it's really exciting. If you think peer-to-peer in other spaces like Uber with with transportation, Airbnb. It's a really, really cool model, right? But in finance, it's just got so associated to consumer finance. So, Harmoney, I guess, in the New Zealand context, took us there. High cost borrowing and fees, to consumers who may or may not be able to afford it. And I say it like that because it really comes down to perception. And I think the perception of consumer finance lenders is generally that they're lending to the unbanked.
Yeah, finance company. It's like those words should conjure up kind of institutional solidity and being in the financial system and high quality organisations.
But not in New Zealand.
But not in New Zealand. Like those words together do feel like a bit loan sharky and a bit third tier and a bit exploitative or parasitical or something. And yeah, like an unfair balance, which is funny, right? Because like they shouldn't. They do.
They do, and they shouldn't. So we call it peer-to-peer, but I think peer-to-peer is more a descriptor of what we do as opposed to, this kind of finance company type scenario. So peer-to-peer lending. On the one side, we've got borrowers. Now, our borrowers are first mortgages, so people buying property or developing property. And then on the other side, we've got retail investors, mum and dad investors, not just mum and dads. We've got lots of young people and all sorts of people, but retail investors, and we're matching them up. Now, the way that we do that is that we look after all of that complexity for them. So from an investor perspective, all you're doing is investing into into home loans or construction loans or consumer loans. And then we're going and matching that up. And then on the other side, there's a borrower. So essentially, we're doing what a bank does using peer-to-peer technology because that's all that a bank does.
Yeah, and by that, do you mean if you put your deposits in at a bank, they have a person, people in their team who decide what kind of things those deposits are lent to or used for. But here, your technology in the middle that allows people to choose to do that? Or do you still do that?
We still do that. So our system automatically assigns them into loans. We do the credit decisioning and the rest of it. So we do effectively behave like a bank. And what's really interesting with our peer-to-peer platform is that we've got reserve funds. So part of the interest that borrowers pay goes into reserve funds. Those reserve funds are there for the benefit of investors so that if a borrower defaults on the loan or misses a payment, the reserve fund kicks in and makes the payment. And what that means is that none of our investors have lost 1 cent since the platform launched, not even for a day. So any missed payment has been made up by the reserve funds.
And so like a bank, but not a bank. Why not be a bank? Like, what does it take to be a bank?
Well, this is the thing. If you were to be a bank, you're just copying a model that's been around for hundreds of years and proven, obviously, which is good and institutional. But if you want to do something different and you want to challenge the way that banking works and provide what I think will ultimately be a better way, then we think that this path has got some real legs. But it's going to take a long time. The thing with banking is it's a trust-based industry. They're called institutions because they've been around for hundreds of years and, they've literally got this physical infrastructure, right? And people trust it. And there's a lot of regulation. They hold lots of capital. And, to put something in place to challenge that model is going to take a very, very long time.
I'd imagine too that like lots of people who deal with banks don't know and don't care about any of that detail. So even having to tell people that detail probably for a big swathe of the population don't care, don't want to care, right? So
100%.
Like you're like, yeah, but we do all the same kind of stuff, but it's cleverer. It's like
I don't care.
Too hard.
Too hard. Well, that's it. There's a huge amount of apathy, in the retail market when it comes to your money. It's been really interesting with these new investment platforms like Sharesies and so on, to see people embracing that. And I think they embrace that because it's just a platform. And it's just a lower cost and easier way of investing in shares. Whereas with a platform like ours, essentially it's doing the same sort of thing, but it's your money and it's been invested into loans, and suddenly it feels a little bit scarier.
Yeah, because they don't do a lot of talking about any of that stuff when they're asking people to sign up for a checking account or anything. But and you said that when you were working at the bank, you're thinking, I'll kind of start my own bank kind of thing. I've talked to a few people who are doing interesting things that in other countries might be called neobanky type things.
Yeah.
But the thing that I don't think gets enough awareness here is that innovation in this space in a place like Singapore, you put $5 million down and you've got yourself the license to run a bank. Here, what's the situation here, and where's it going? Like when it should be coming down to allow more people to innovate, it looks like it's just going to stay high or go up.
Yeah, look, we haven't got the regulatory sandpits that they've got overseas that have allowed these kind of neobanks to start up with low levels of capital and with much lighter regulation. The hurdles to creating a bank are very, very high.
But if open banking was truly in place, would they be that high?
Yeah, look, I still think so. And I think rightly so, to be honest. Look, most neobanks have failed. If you look at the Australian market, a number of the, Australian neobanks just disappeared in the last 3 or 4 years. In fact, most of them. I think Judo's the only one that's still going over there. The ones that seem to have been successful are the ones that focus on business banking, where there's a real big sort of product market gap. Those that have been sort of trying to build into retail have really struggled. And where they've had some success recently is just a high interest rate environment, because what neobanks have been quite good at doing is building deposit bases. And suddenly those deposit bases are actually worth something because, interest rates are up globally around sort of 5.5% now. So these neobanks can actually earn income. Whereas, when interest rates were really low, they were building these customer bases and building this, these sort of transactional balances, but they weren't earning anything and they were losing a ton of money. I think Starling in the UK is a really good example of one of these sort of startup banks that's actually managed to get to profitability through building a big deposit base. They're not full banks. They don't, that I guess lending's been something that's been challenging for them, but they're gradually getting into it.
There's a bit of a tax on the economy a lot of these banks have, right? And the cool thing about neobanks and the cool thing about some of these innovators has been, Wise actually, TransferWise now.
I love Wise, yeah.
Actually bringing down the cost of foreign exchange transfers.
Yep.
Revolut, bringing down the cost of traveling across Europe and places where there were lots of bureaucracy and lots of kind of costs to do business. They've really served it. And then if you look at, if you're a small business owner or something in New Zealand and you look at your statement, you're like, merchant services fee, foreign exchange fee, FPOS fee, the amount of, 3% on every credit transaction, Apple Pay costs. There are so many kind of drags put on the economy by these banks once they get to their scale. And it feels like in New Zealand, because we've been so slow to adopt the open banking principles, that it's still a long way from all of this kind of falling away for us here.
Yeah, look, it's really interesting. One of the things I'd sort of say is, we've only got a population of 5 million people, and to build any business that is domestically focused is really hard. most successful businesses, and certainly the ones that attract, maybe private equity capital and stuff, export focused or globally focused, solving a problem that you can take to the world. When you're solving a problem that's domestic, it's very difficult to get, private equity markets and stuff interested because the problem you're solving is not big enough.
Yeah. And we're a suburb in a big city.
Yeah. And then, to build a business, on low margins in a small market is really, really hard. And so when you think about banking, it is a low margin business and it's very scale orientated, and we've only got 5 million people. So it's really, really difficult to displace your big players and to find enough market share to make it viable. If you look at it, you've still got your big four banks, Kiwi Bank's coming through, but only because it's been government owned and has had access to capital and patient capital that's been prepared to sit there because, its return on capital has been pretty poor now for, over a decade. It's improving, but it's not really going to get a good return on capital until it's much more scaled. And then below that, you're into the likes of TSB, SBS, Cooperative Bank, none of whom have been able to scale into this market, none of whom have been able to make a material difference to banking. The reality is we've got that small economy problem that means that, these banks are actually very, very good at delivering high-quality service at low cost. They make a ton of money doing it because of the scale of those businesses. But they're huge businesses, with huge amounts of infrastructure. I think that's what I still love about banking is just I love the complexity of it.
And they're a really big chunk of our economy because buying and selling homes to each other is such a big part of our economy. Where do you sit on that? And I guess like having mortgage broking is such a big part of the business. It's such an important part of people's lives to be able to, get a home and have the stability and stuff. But our economy does seem to be somewhat over-indexed on unproductive assets, right?
100%. You're not going to hear me disagree with that. It's a real shame that so much of our capital goes into buying and selling houses off each other. Because let's face it, households carry such high levels of debt. Kiwis are sort of up around 45% of their after-tax income is going into servicing a mortgage or, paying rent. It's just too high. We are a real slave to home ownership. And look, there's a whole lot of reasons for that. We've never really fixed it. It's frustrating. I think, I was saying to someone the other day, it just feels like, it's pass the parcel between, different political parties that do nothing, it just keeps going left, right, left, right, left, right, but no one really solves the fundamental problems that we have here. And I don't think really anyone's got a great vision, at least in the major parties, about where we're going. It's frustrating. I think everyone would agree that, housing affordability is a really big issue in New Zealand and Australia. We're not alone in this. It's frustrating. But hey, Simon, I was just going to say, look, the banks do make a lot of money. Where they've made money recently is not so much on mortgages. Everyone assumes mortgages. Mortgage margins are around just a little over 1%, which means on a $700,000 mortgage, the bank's clearing about $7,000 a year on it. So you go, actually, that's not a lot of money, right? But the scale of it means, they certainly make pretty good money on it. Where they've really been making money in the last 2 or 3 years is as global interest rates have gone up, they haven't passed that on to depositors. So it's really depositors who are losing out from a competition perspective at the moment because banks just aren't paying them enough.
Yeah, isn't that interesting? Because I've always had a thought that, banks and payments and stuff pretty good businesses, because there's not many businesses where you get to invent inventory. So,
Yeah.
I imagine most people who are listening this deep on a bit of a bank nerd podcast would know. But, the ability to be able to, when you write a mortgage, actually invent a bunch of the money that you're passing on to your customers and then charge them for the privilege. Pretty good business model for the banks.
Absolutely. It's one of the great industries, isn't it? It's interesting. So when I was looking at it strategically, and I come from a strategy background, I ran strategy at the bank for a while. I sort of looked at all of the aspects of banking and said, okay, where do we want to compete and where don't we want to compete? One of the areas that I eliminated pretty much straight away was payments. It's something that we could have done, but it was I dismissed it very early on. And the reason is that, from my perspective, payments is a global game. It's not a domestic game. And fundamentally, I've had this view for about 10 years, so I was way ahead of the pack. But my view was, and has always been, that ultimately technology was going to solve the payment problems at a global level. And so unless you're building something with a global perspective, you're wasting your time in payments.
And we're about to see an enormous new shake-up to the payments industry.
I'm so excited about it.
With Apple having the chip technology now being added to, or it's already in a bunch of the technology, and that'll be turning on soon. So we're about to see a whole lot of intermediaries that have been providing, FPOS and chip technology and clipping the ticket, about to lose a lot of their business. Well,
think about Visa and MasterCard, right? The one that I'm really excited about at the moment is PayPal's stablecoin. Because PayPal's got such a massive network on both sides in terms of consumers, but also businesses.
And being that, is it Braintree, being the infrastructure of so much of the payments system?
Yeah. And so you introduce a stablecoin into that, and that's a game changer. So, you're talking about merchant service fees and interchange, which is pretty much what, a lot of these neobanks have relied on, because, companies like Revolut and Monzo and to a lesser extent Starling in the UK have relied on that merchant service fee interchange model to make their neobanks work. Certainly early on when they were subscale, right? And but that's all going to disappear. I mean, this next wave of innovation is gonna really attack things like merchant service fees and interchange, because stable coins going to completely remove that. It's going to take transaction costs close to zero. I'm so excited about that. But the reason that they can do that is because global business models, international standards allow that to happen. So you take a step back and you go, well, what are the aspects of banking that aren't global, that will always be domestically managed because of regulation and stuff? And it comes back to deposits and borrowing, right? Because that's always going to be nuanced to individual markets. In terms of credit quality, in terms of regulatory protection for borrowers like triple CFA, even different ways of owning property and different ways of transacting that. And then on the deposit side of it, obviously, every economy, it's critical that you have a financial system that's robust and stable so that people can trust it. And
and for all of the chat about, the Australian-owned banks taking too much profit out, like you say, the actual return on capital, not crazy high, with the amount of capital involved. And their stability is one of the reasons that New Zealand has had a reasonably smooth ride through the last 10 years, right?
Yeah, absolutely.
Yeah. And then in terms of your journey at Squirrel, so you started at a really hard moment and then built the business up to a really significant size for an independent in a, place where your competitors are pretty big as well with the banks, or collaborator frenemies, I guess.
Yeah, frenemies is a good way of describing it.
You recently-ish decided to step out of the CEO and become more of a kind of advocate and strategy person for the business. How's that going? And how was that journey as someone who, made your own thing in the world?
Yeah, I love it. I think probably, look, I'm not a good CEO, and I think you'll find a lot of founders will sort of fess up to that eventually. I got out of banking because I didn't like all of the management that comes with large number of people. It's just not my thing. I'm not disciplined enough and structured enough to kind of be a good CEO. And so about a year ago, a really good friend of mine who I trust and really respect, I'd rate him as one of the top retail bankers in New Zealand, David Cunningham. He was the CEO of Cooperative Bank. He'd been at Westpac. He'd stepped into Cooperative Bank, which was a big shift for him, but he loved it, more community-orientated sort of business. And he was wrapping up at the Cooperative Bank. He was taking a year off. He was going to cycle across Australia and stuff. And I was talking to him quite regularly. And I'd always imagined I'd work with Dave again, but he was my first boss when I got into banking. But it was just going to be so expensive, and I couldn't afford it. And but I was like, I've got to bite the bullet. And so I convinced the board that we needed to take him on, and we did. And I stepped back pretty much straight away and said, right, I'm going to go cold turkey, because being the founder, everyone's just going to constantly look at me. So I actually stepped completely out of the senior management team straight away, gave Dave the space to get on with it, and tried not to talk to them, literally tried to direct any thoughts or conversations I had to Dave, and really step away from the business. And it's hard. It's hard. There were times there, it can get a little emotional at times. It was hard, but, 2 or 3 months in, it got a lot easier. I've actually stepped back in now, very much focused on the advisory side of the business, which is the brokering side. Because I felt that needed a bit of love. And Dave's very focused at the moment on our peer-to-peer side of the business and growing that, because it's a complex business. And I think we're almost like two CEOs. Dave runs the show, but we've got two very experienced bankers who we're able to deploy to different parts of the business to ensure that we've got enough sort of experience and focus to get what essentially are two businesses working together.
What would your advice be for people who, I don't know, maybe have got themselves to a pretty good position in a corporate world or in the business world and think maybe I will give it a go myself, pick off a big old industry?
Don't! Oh my God, I just about failed twice. I got so close to being bankrupt. It's cool. It's 10 times harder than you think. I think there's that 7 Signals. I forget the book that they wrote, but I loved it. And they've got this quote that says it takes 10 years to be an overnight success. And in all honesty, possibly even longer than that. It's hard work, right? I've been going at this for 15 years. It's really interesting because at some point in the next 1 or 2 years, people will be going, wow, where did he come from? And it's like, because I don't think we're there yet. I think a lot of people know Squirrel. I think we've got a reasonably high public profile, but I don't think people really understand just what we're doing, particularly around building this alternative banking infrastructure. It's pretty special. Like the technology that we've built is remarkable, but no one really sees it because it's all under the surface. But in a couple of years, I think people will realize what we've done, and they'll be like, wow, where did this come from? And it's like, well, it's been a 17, 18-year journey. I mean, I started this journey when I was 35. I'm 50 now. Jeez. Scary.
and as a final kind of thought, what will success be for Squirrel kind of in the market and in the world, and for you personally?
Yeah, well, I don't know. Success for me is like climbing a mountain. So it's the fulfillment of a dream, or, you know, having an idea of what's possible and then achieving it. And we're not there yet, but it feels like we're finally validating it. You know, like we're seeing enough evidence now that what we're doing is the right thing, that I think we're genuinely excited about the future. It takes a long time to take on the banks. You know, it's not a fast journey. For me, that's incredibly fulfilling. We want Squirrel to still be around in 100 years. You know, we at Squirrel, we don't want to be consumed by a bank, which would be the easy out. You know, because if they see us eventually as a competitive threat, they've got so much money, they just buy it. We don't want that. I want to list at some point. The reason I want to list is not to get money out and suddenly be rich. I want to list because I think that that's the way to ensure that Squirrel stays a New Zealand business, but in a way is publicly owned, you know, is owned by the people of New Zealand. That feels like a really good place to be. I'm currently a 60% shareholder. I'll probably end up down around 30%, and I think that 30% will be locked away forever. So, you know, I have no intention of, you know, selling out of Squirrel. I'm not looking for an exit. I'm looking for a strategic cornerstone in the business to ensure that the business that we build will still be here in 100 years, still doing what we want it to do.
Yeah, wow. I can't wait to see where you take it next on this overnight success. It's John Bolton, JB, the founder at Squirrel. Thank you for being here today. Thank you so much to John. Thank you to you for listening, to everyone who helps make this happen, like our producer, Samuel Robinson. Do follow Business is Boring wherever you get your podcasts, and be sure to rate and leave a review if you like what we do. E no hora.